in partnership with CommSec.
Alrighty, let's have a look at the markets now. Tom Piotrowski, you over at CommSec. How are we shaping up today, Tom?
Pete, no, not too bad actually. We've got the futures pointing to an improvement of around 0.75% for the ASX 200 when trade gets underway later on this morning. So in addition to that 0.8% improvement that we saw yesterday, so a nucleus of optimism beginning to form. It's just a question of whether or not that will continue. We have seen encouraging outcomes in the Northern Hemisphere last night, Pete. So the first day of a new trading week has seen solid gains for both US and European markets. There have been some important initiatives announced, including Chinese efforts to stimulate their economy yesterday. The German Parliament will vote on a very important piece of legislation in the coming day, which will see limits on military spending removed and an important infrastructure fund established. So those stimulus measures come at an important time for the markets when they're wrangling with the idea of where global growth is headed. So that's significant. Later on in the week, we'll see the US Federal Reserve's view of the world. They'll be voting on an interest rate decision. They're expected to leave rates on hold, but their growth projections will be important at a time when US investors in particular are trying to work out what impost the tariffs will have on growth. So having said all of that, the Dow Jones up by a little over 1%, the S&P 500 up 0.9%, the Nasdaq up by around 0.7%. European markets, as I said, did quite well last night. You had the French market up 0.6%, the UK market was up by a similar amount, the German DAX up by around 0.75%. Energy stocks have been amongst the most improved in the Northern Hemisphere, Pete. We've seen oil prices up by around 0.75%. They're hoping that those growth initiatives from China are going to help demand for energy, and the Aussie dollar trading nicely higher at 63.9 US cents with the US dollar at a 5-month low.
All right, Tom. Thank you.